Well, from economic data, let's shift to the Fed, which concludes its two-day meeting today. Is going to have an announcement this afternoon. Brian Cheung's back with us, and we talked about your FOMC 3 yesterday, Brian, your three predictions. But specifically, I want to talk a little bit more about the Fed balance sheet, right? Because we have seen this unprecedented expansion of the balance sheet. And now, as I mentioned, we are starting to talk more and more about inflation going into next year. For years now, it feels like, Brian, there have been predictions that that increase in the balance sheet was going to cause inflation. Didn't really happen. So, how are you thinking about the asset purchases going into this afternoon, and then inflation alongside that?
Well, the Federal Reserve, when they do make their policy announcement again today at 2 p.m., they'll be trying to codify those two things and even other factors together. The reason why that is because we already know that the Federal Reserve has been buying an unprecedented amount of purchases per month. Right now, it's pacing at about $120 billion per month, $80 billion a month in US Treasuries, $40 billion per month in agency mortgage backed securities. And the Federal Reserve already had said earlier in the year that it was going to purchase at least that amount per month, although it's been kind of keeping at that clip. But the question is going to be whether or not they can offer more forward guidance on how they might adjust that going forward. So for the longest time, markets have just said, okay, we know that $120 billion is kind of the floor there, but we don't know what the ceiling would be and how they might adjust that ceiling depending on how economic conditions develop. And that's why things like inflation, as you just mentioned, could be very important. As we know, the Federal Reserve adjusted its framework in August of this year to say, we are willing to tolerate inflation that's moderately above its 2% target as long as it shows that it's not going to run away. But we are okay with seeing core PCE figures, it's again preferred measure of inflation, above that 2% level for some time. But I think the bigger factor is also going to be maximum employment. Again, the second part of the Fed's dual mandate. The Federal Reserve is obviously well far away from that pre-COVID level of 3.5% unemployment. The Federal Reserve would really like to get back to that point in time before it then signals to markets, hey, we're ready to then dial back or taper. I don't want to use the T word, but taper that pace of asset purchases. So that's something that we're going to look forward to in that press conference today. Now, nothing about them messaging forward guidance might necessarily change the pace of asset purchases today. So if there were to be some sort of new guidance from the Fed, it would be, again, linguistic changes, not necessarily actual actions today that would say, hey, we're going to ramp up the aggregate amount or the duration of the purchases that we're doing. But again, we'll have the full coverage of that press conference and the statement right here on Yahoo Finance.
I would just like to say that this really brings Brian Cheung back into his element, because now we're doing Fed close reading. This is real Fedology. This is not straightforward. Here's what the Fed is doing. Now we're parsing the meaning of individual words, and we all know that that is when Fed watching is truly in full flight. And everybody else who says, I really don't know what this means, they all just start tuning out and go back to doing more interesting things, frankly.
Yeah, well, I've got my magnifying glass, so I can zoom into each of those words in the future. So again, I'm nerding out, but we'll see how much everyone else cares when that meeting happens later this afternoon.
I was going to say there is no one I would rather have doing it than our own Brian Cheung. So I'm glad that he is with us and will be with us and covering that announcement today.